Most people think the only way to reduce your tax bill in retirement is to earn less or spend less. But what if I told you that you can potentially lower your tax bracket without giving up your lifestyle? This is something that catches people by surprise all the time, and it's one of the biggest opportunities in retirement planning that often gets overlooked. I'm Cary Green, financial advisor and co-founder of Green Era Financial, and I help people close to or in retirement to get the most out of life with their money. And today we're going to talk about how to lower your tax bracket in retirement without earning less and without compromising the kind of retirement you actually want to live. So let's start by looking at how your income is actually taxed in retirement. A lot of people assume that income is income and that all of it is taxed the same way. But the truth is, not all income is created equal. Your tax bracket is based on what's called taxable income, but different sources of retirement income are taxed differently. For example, withdrawals from a traditional IRA or 401k are taxed as ordinary income. Social Security, on the other hand, may be up to 85% taxable, but that depends on how much other income you have. And then you have capital gains, which are taxed at lower rates, and Roth IRA withdrawals, which are completely tax-free if done correctly. The key point here is that how you generate income in retirement matters, just as much as how much income you generate. For example, you could have two retirees both pulling in $80,000 a year, and one could be in a much higher tax bracket than the other, simply because of where that income is coming from. So let's talk about how to take advantage of this. One of the most powerful ways to manage your tax bracket is to think in terms of what we call the retirement tax triangle. This refers to the three main types of accounts most people use to generate retirement income. First, you have tax-deferred accounts like traditional IRAs and 401ks. Second, you have tax-free accounts like Roth IRAs or HSA withdrawals if used for qualified expenses. And third, you have taxable accounts, brokerage accounts, savings accounts, CDs, and so on. The idea is to blend your withdrawals across these different account types to control your taxable income. For example, let's say you need $80,000 this year to live comfortably. Instead of taking the entire amount from your traditional IRA, which would count as $80,000 of ordinary income, you might take $40,000 from your IRA, $20,000 from a Roth IRA, and $20,000 from a brokerage account where the income is partially taxed as capital gains. Because only a portion of that income is taxable, you could potentially stay in a much lower tax bracket, and that means paying less tax overall, this year and for your lifetime. Now, one of the best times to take advantage of this strategy is in the years just after you retire, but before you begin taking Social Security or required minimum distributions. For example, let's say you retire at age 64 and delay taking Social Security until age 67. That gives you a 3-year window where your income might be unusually low. That window is a prime opportunity to do something called a Roth conversion. A Roth conversion means moving money from a traditional IRA into a Roth IRA and paying tax on that amount now. The benefit is that the money then grows tax-free in the Roth IRA, and you can take it out tax-free later on. If you do that conversion while you're in a low tax bracket, the tax cost might be relatively small. Even converting modest amounts, say $10,000 or $20,000 a year, can make a huge difference over time on your lifetime tax burden. Not only do you get more money growing tax-free, but you also reduce the size of your traditional IRA, which means lower required minimum distributions later and possibly lower Medicare premiums too. Now, Roth conversions are not right for everyone. They have definite pros and cons, and there's times where they can make a lot of sense for somebody, and there's times where they definitely don't make sense for somebody. But it is one of the strategies you can implement to reduce your tax bracket over the lifetime of your retirement. Now, speaking of Medicare premiums, this is where things can get a bit tricky. Medicare premiums are based on your income from 2 years prior. So if you spike your income today by doing a large Roth conversion, for example, it could increase your Medicare premiums down the road. That's why it's important to be strategic and avoid converting so much that it bumps you into a higher IRMA bracket. Sometimes doing a series of smaller conversions over several years is the smarter play. Now, another important thing to understand is how capital gains are taxed. Long-term capital gains, which apply to investments you've held for over a year, are taxed at their own set of brackets, and they stack on top of your ordinary income. What that means is this: if your ordinary income is low enough, you might pay 0% on long-term capital gains. But if your ordinary income is too high, more of those gains could get taxed at 15% or even 20% in some cases. So again, managing how much income you recognize from your IRA, for example, can help preserve those lower capital gains brackets. Now, let me give you a bonus strategy that applies to those of you who are over 70 and a half and are charitably inclined. It's called a qualified charitable distribution, or QCD for short. This allows you to donate directly from your IRA to a qualified charity. The amount you donate counts towards your required minimum distributions, but it doesn't count as taxable income. This is one of the only ways you can directly reduce your taxable income using IRA money after you've already hit RMD age. It's a powerful strategy if you're looking to reduce taxes and support causes you care about. So what's the big takeaway here? It's that managing your tax bracket in retirement isn't about earning less, it's about being smart with where your income comes from. Blending distributions from your IRA, your Roth, and your taxable brokerage account, timing your Social Security and Roth conversion strategically, being thoughtful about capital gains, and using tools like QCDs when appropriate. Retirement tax planning is not just a one-time decision, it's a year-by-year strategy. And with the right approach, you can lower your tax bracket without sacrificing your lifestyle. You don't have to live on less to pay less in taxes. You just need to plan smart. So if you want help putting together a strategy that reduces your tax burden and helps you keep more of your money working for you in retirement, feel free to reach out to me. I'm always happy to help if I can. And thanks for watching. I'll see you next time.